Friday morning. As always, excited to have the opportunity to talk about the markets with you and uh, go over some of the open positions that we have going on right now with our Rebel income trades. As always, the market is continues to be an interesting animal, um, and we'll get into that as we get things rolling. We are the market is just barely off and running. Obviously, having starting at our starting time at 9:30 Eastern, 7:30 where I am, means that we're starting with the market bell. So we're off and running. We'll see where the market goes today, but it's been an interesting week for sure. A couple of things really quickly. If you want to interact with me, have questions or comments. Um, have questions or comments during the session, please do use the chat over on the right-hand side of the YouTube screen. I'll be watching that and appreciate your participation throughout the course of the session today. Also, for those of you who may be on some of the different platforms that I publish on, I want to talk really quickly about how you can interact with me and with the group during the week. If you're on Discord, the easiest way to do this is, excuse me, is through the open discussion forum. This is a forum a channel that I set up on the Discord server to allow you to send messages to me, to interact with the rest of the group, to be able to share comments, questions, and perspectives as a community. Feel free to use that. Barry and Jay in particular have been some of the more active ones in the group in that channel, but want to encourage you to use that. I watch that throughout the course of the day, try to respond as quickly as I can when I see comments there. All right. If you are on Substack, you also have a couple of different ways to you can also use the chat feature. I've enabled that here, and you can go ahead and post comments, respond to me there, and send messages directly to me through Substack. So whatever your preference is, please do feel free to use those tools. And as always, you can also email me anytime at rebelincomesystem@gmail.com. Okay. So that's enough of that. Let's go ahead and dive straight in. It is, as always, it's Friday. That means that we have options that are set for expiry. Most of the open put sales that I've been placing lately, kind of like with last month, there were a lot of just about all of the interesting setups, or useful setups, I should say, kind of occurred at the last weekend, or excuse me, the third week in April, which is the standard expiration Friday for options in general. Kind of have the same thing going on right now with May, where most of the trades that have been available, the most useful contracts have been available for the May week 3 expiration, which is I think the 16th. And so that's been an interesting thing to see happening. And yeah, the 16th. But we have a few trades to talk about. We'll get into those. We do have one on deck for expiry. That's a covered call. So we'll start with that one, and that is on Barrick Gold. Now, this is a position that I've held on to for a while. I was assigned this stock at $20.50. So that's what I own 300 shares, excuse me. Sold 3 contracts, was assigned 300 shares. And so this covered call was useful. This was a 16-day trade, a little over 2 weeks, bringing in almost 3% yield for the time period. Now that's been this is a stock that took advantage of some of the early volatility in the market in April that was driven by fears around tariffs. Now that perspective has certainly changed, and here we can see. Okay, good. Apologize for the interruption. There we go. Okay. You know, the market for the last week or so has really been rebounding pretty strongly. A lot of that has been driven by news that maybe tariffs won't be as aggressive as originally announced, and that forced the market down to test some bear market levels at the very beginning of the month. So this early volatility, change my color here. This early volatility pushed Barrick and precious metals in general up to some pretty interesting levels. And so it peaked near about 21, middle of the month, around when I placed placed the covered call. It's fallen back since then. Now it's about 1855, starting to bounce off of the 200-day moving average. So it looks like this option is going to expire worthless. I'm going to continue to hold Barrick for a little bit longer, and that's okay with me. This is a really, really good example of a stock that I do think is a good hedge against volatility related to recession fears, inflation risks, some of those kinds of things. And it's also a stock this is a company I like to own. They don't pay a huge dividend, but their dividend is certainly useful enough to be practical. It's yielding a little over 2% right now. And so those dividends have been coming in for the duration of the time that I've been holding the stock. And we'll see if maybe the next earnings report gives it another bounce higher. But I'm willing to be patient. This is a company I like. I don't mind having it in my portfolio, and it has been productive. So that option looks like is going to expire worthless. That's all right. Okay. Let's go ahead and talk about the put sales. By the way, it looks like there's going to, considering the number of trades that I have on deck, it looks like there's a really, really good chance that we're going to have some time today. So if there are some stocks that you are interested in, you don't mind sharing with the group, and that you might like to have me put some eyes on during the session, get some comments on, feel free to let me know. Again, use the chat area, and I'll be happy to talk about those. Okay, let's talk first about CAG. This is Conagra Brands. This was a put sale that I placed about 2 weeks ago, selling the $25 strike price and bringing in 3% for about a 30-day trade. So we're about 2 weeks in. Again, this was the first one with the May week 3 expiration that I was talking about earlier. And this is a good trade. Again, this was one that was taking advantage of that increased volatility that we saw through most of April. Looks like May is trying to start off on a more positive note. We'll see if that continues, obviously, depending on the way that news tends to read events. And what happens, honestly, let's face it, what the people in the White House decide to do at any given moment. All right. So for this put sale on Conagra, I sold the $25 strike price. Let's check in with it and see where it stands right now. And it's slumping just a little bit. It's a little bit below 25 now, starting to approach 24. So we're seeing a little bit of a decline in the stock. If you place the same trade like I did, if you're working with the same strike price, you're a little bit underwater here, still with 2 weeks to expiration. So that brings up a question. What do we do? Is the fact that I'm going to change my color here. 25 is the strike price that I sold. Excuse me just a sec. The fact that I sold the $25 strike price and the stock is now approaching 24. It looks like it's trying to test support here at this level right now. Is this a reason to panic? Okay, Barry, you were assigned CAG yesterday. Interesting. And that can happen. These are American style options. So as soon as the stock drops below the price that the strike price that you sold, you can be assigned. Doesn't mean you will, but it does mean you can be assigned. Typically, I would expect to see that happen if the stock is a little bit more volatile than it has been, but that can still happen. So, Barry, you have your shares right now, just barely missed the dividend by a couple of days. And Barry, did you sell 25 as well, or were you working with a different strike price? They were waiting on you this morning. Gotcha. Sometimes it feels that way, right? Oh, wait a minute. That must be Barry, or that must be Thomas. Sometimes I get that feeling. I really do. Okay, also sold the 25. Interesting. So that does beg a question. A little bit underwater. Barry on shares of the stock. For me, the put sell, I have not been assigned. Not going to discount the possibility that I could. Only that I haven't yet. Let's take a look at Conagra here. Question is this something that you feel like is a problem? And if you're still holding the put sale, as I am, this opens up an opportunity to do a little bit of evaluation. Now, keep in mind on this one, I brought in, I brought in 75 cents on the put sale. So that's the credit that came into my account. So if I'm 2 weeks from expiration and I want to try to minimize my risk a little bit, limit my potential loss, what does that mean? Well, if I want to manage my positions a little bit more actively than I do by default, but that some of the people in our group do prefer to do, that means buying this option back. Here's 25. Buying it back to close the position means buying at the ask price, putting in an order buy to close. Using the asking price as a reference, with it at $1.15 right now, that means that I would end up absorbing a loss here of 40 cents per share. A little minus sign there. Now, what's the good about making that kind of a decision? What's the bad part about it? Is there a bad part about making that decision, for that matter? This is a subjective question. Not everybody is going to answer this the same way, and that's why when I pull out when I open my coward's door and say this isn't a recommendation to buy or sell, this is part of the reason why, because this is going to be different for everybody depending on what your preference is, what your real approach to the positions you're looking at is. I talk a lot in this live stream about the advantage of trading frequency. And if you're one of the people in the group that likes to roll trades, which means if the stock is moving for you in a positive direction, you have an opportunity to buy an option back to close the position for 50% or more of what you originally brought in credit to your account, then in a lot of cases that works in your favor, because you shorten the time period that you're working with the position, And by so doing, you also increase the trading frequency. So you create advantages in those cases that repeated over and over and over again translate to higher overall returns. The flip side of that approach is that you also need to be willing to consider doing what we're talking about right now with CAG very seriously. And the asking price has just changed to $1.20 now, so now we're looking at a potential loss of 45 cents if I were to close this out, taking the sell to close price. If you're going to be buying back more quickly when the stock is moving in your favor to try to take advantage of the opportunity to possibly roll a trade into a new strike price, new expiration, etc., you also need to be very realistic about trying to limit the loss more actively on the downside if the stock has moved against you. So that may mean that this closing out the trade here is a smart thing. Limiting the loss to 40 or 45 cents, well, now 50 cents because it's changed again. That may be a smart thing. Now, I sold, let me double check here. I sold 2 contracts. So I'm on the hook for 200 shares at $25. That's a $5,000 commitment that I'm making to that stock right now. And now it's actually cut down a little bit below 2024. And we've seen this increase to 60 cents. Look at that. I may be looking, I may end up with an assignment before the end of the day. Who knows, Barry? Just like you. What this does, though, is it limits the loss. Even if I took it at what it is right now 60 cents on the 25, $1.25. Wow. Sorry about that. So even if I took it at $1.25, that's 50 cents. That would limit my total loss on this position to $100. On a $5,000 commitment, $100 is pretty minimal. I'm not saying there's not some emotion attached to that. There always is anytime you're having to absorb a loss. But in terms of money management, in terms of trade management, again, if you're being more active about managing your positions, this makes sense. And so if you are in the category of people who are trying to leverage trading frequency by being a more active roller, then that might make sense. Myself, again, Conagra is a company I like. I like it at 25. Yes, it's below that price right now, and that means that I may be looking at a different kind of assignment here, or a different kind of position than normal, where the stock is moving lower and below the strike price. Carl says, free up the commitment, move on. And again, nothing. That's why I'm presenting this possibility. Thank you, Carl. I appreciate that, and I'm so happy to see you again. $100 loss, that's minimal. It frees up the rest of my capital. The other $4,900, I can move on and I can go find something else. My normal approach is to let this play out and let this go and run to expiration. I don't mind that. I'm not afraid of it. If I like it at 25, then even if it's down at 24, that doesn't bother me too much, because I do believe the value proposition on this stock is much higher. And so even if I am assigned early, as Barry was, that's okay with me. That doesn't make me afraid of the stock. In fact, what it does do is it opens up the opportunity to evaluate the potential for a new income trade. And going out here over on the covered call side, bid even at 25 is only 20 cents. That's not great. 30 cents for 35. Probably need to wait for the stock to rally back again towards 24 before a covered call trade starts to become really practical here. But this is the kind of evaluation that I think you need to be able and be willing to run through, no matter whether you are more passive, take a little bit more passive approach to managing the trades. You're willing to let them play out to expiration, as I am, or if your preference is to be a little bit more active. This kind of evaluation should be happening on a regular basis as soon as you see an open position drop below. So yeah, Barry, you're right. It is still in the price drop phase. That is very true. It has been dropping for the last 3 days, and we're seeing it's really testing support down here. I was saying 24, but it looks like it might be a little bit closer here to 23.50, roughly. Is it going to stabilize? Who knows? Some of the stocks that benefited initially or were more stable in April, like food stocks, some more conservative kind of defensive plays, are taking it on the chin right now as the market is starting to take a little bit more of a risk on approach. Generally on the expectation that maybe some tariff agreements are coming. The progress on the trade front is going to be seen. So we'll see how that goes. On a macroeconomic perspective, I just want to observe really quick right here on my watch list over on the right hand side. These are the symbols for Brent oil and West Texas crude. I keep these on my list just so that I can try to see what's happening with them on a regular basis. Seeing Brent down around 61 and WTI below 60, that hasn't happened in a while. Not saying that that's good or bad. It's interesting. Putting some pressure on oil producers, to be sure. Maybe creating some opportunities in the energy sector as well. Okay. So that's Conagra. We also looked at the covered call on Barrick. Let's talk about Levi. Talk about Levi Strauss here. This is a put sale from last week. I sold the $14 strike price and brought in a little under 3% for a 3-week trade. Again, same expiration as the rest. So let's check in on this one and see where we stand. So this one looks a little bit better than Conagra, and it is benefiting from some of the positive momentum that the market is seeing. And we're up here at 16, so this looks like this is in a pretty good position right now. And again, if you're going to be a more active income generator, seeing the stock about a little over $2 above the strike price that I sold opens up an opportunity to think about the opposite side of rolling that we were just talking about. Conagra, maybe I want to think about limiting the loss. Maybe here is an opportunity to leverage trading frequency. So here is the asking price on the $14 strike that I sold. 10 cents. I brought in 30, or excuse me, brought in 40. I apologize. Buying this back. This was a positive, this was a credit. Need to get my symbols correct. Have to pay 10 cents to buy it back. That means that I would hang on to 30 cents. If my friend Joe were here, he would be screaming at me right now. This is 75% of the premium that I brought in that I could realize by buying this back right now. That's really interesting. This would close out the trade only a little over a week after I placed it. In fact, 9 days to be precise. And that would also open up the opportunity to take advantage of the stock's bullish momentum and think about maybe selling the $16 strike for another 40 cents. Now, the stock's not a ton above 16, but it is above 16. So that's still a little bit out of the money. So I could sell that, generate another 40 cents, increase the income on the position. Obviously, the capital requirement would increase a little bit by $2. And I sold 3 contracts on this at 14. So that's about a sorry, I'm trying to do math in my head. We know what that does. That's not great. So hang on a second. $4,200 commitment. I should have been able to do that math in my head, but I didn't. So that's about a $4,200 commitment. That would increase by 300, so we'd go to about 45. Well, actually about 600. So that would go to 1632, 4,800. So a little under 5,000. Still a pretty conservative position if I wanted to roll up, take a little bit more of my capital, but would the result here initially, and maybe the positive here is that it would increase the income so far to 70 cents on an average strike of 15. That's after 1 week with time to spare still. So 70 cents. The average commitment here is 4,500. Sorry, I'll just say 0.7 divide by 15. That's 4.66% in just about a week. Again, there's people that have been in this group that would be screaming at me, "Why aren't you doing this trade right now?" Not a recommendation. Again, it depends on what your preference is. For now, I'm comfortable with the fact that Levi is moving in a positive fashion for me, and that's good enough. But these are some of the possibilities, some of the alternatives that you can think about. The other part of this too is if you buy this back, it doesn't mean that you have to work with Levi again, of course, right? If there's another stock that you like better, you can always simply move on and go work with that other stock. So the advantage of buying back early is that you give yourself more flexibility, financially speaking and functionally. If you want to keep working with the same stock, you can. If you want to If you want to shift gears and move on to something else, you can do that too. Any other thoughts, comments? Feel free to offer up your ideas. All right. The last one is a really, really boring stock that I used for this week's trade. Carl, nickels and dimes add up, and I agree with that 100%. I absolutely do. And so I'm going to go ahead and give you a little bit of a heart on that one because I agree with that. And that's why trading frequency matters. That's why one of the things that I like about the people who do manage their trades more actively than I do, you get more of these nickels and dimes. This is the low-hanging fruit of the market that I talk about so much. And this is how a lot of people create their own advantage. It's just one of the things about trying to be a successful investor with any method that you use that you'll see a lot of people talk about is trying to find your own advantage. And how do you figure out what your advantage in the market is? If you're an income generator, you're selling options the way that we're doing. Selling options with very, very short time frames is one way to start building an advantage for yourself. Managing trades actively can be another advantage if you have the time to do it. If that is something that makes more sense to you, you're going to be able to see those nickels and dimes add up and improve the wealth in your account. In my case, yeah, it's all about discipline. I again totally agree with that, Carl. And the discipline is there's a couple of different sides to the discipline story, because the other thing about trying to find your own advantage is also being willing to understand when an advantage for somebody else could create a disadvantage for you. It doesn't mean that just because it's their advantage that it works against you. It's just, I'm talking about self-awareness. Now, I personally, in my trades, you don't see me managing these trades more actively than I am, and the way that I'm talking about right now, because in all honesty, number one, I don't have the time between just trying to maintain the Rebel Income Service, take care of business every day with that, and the other obligations that I have with my family and otherwise. The system that I follow, that you see me write about, that I talk about in this live stream, is what I can manage. Where you have been in, okay? If you want to elaborate on that, I'm not quite sure what you mean. The more passive approach is what makes sense for me. That is my advantage. Why do I say that? Well, it does mean I take more assignments than rollers do. But I also like the fact that from those assignments, I get opportunities. Sorry, I had hit the enter button. I've done it too. No problem. Owning stocks, the advantage that I get that rollers do not: number one, dividends; number two, opportunities to sell covered calls. It's just a different side of the coin, and it also allows me to manage my system with the time that I have. A lot of early in my career, I was so excited about what I was learning in the markets, so excited about trading, that it kind of started to dominate my life. That created problems with my marriage and with my family. And I had to learn to try to scale things back and learn that and realize very quickly that investing, the markets can be part of my life, but they aren't my life. Trading is not who I am, it's part of what I do. And so investing also needs to, from a quality of life standpoint, needs to have a very specific place, not be the dominant feature of our lives. And so being a more passive income generator, that's what allows me to do that. That is the advantage, is that it keeps me functional, allows me to continue to stay objective about the trades that I make. Now, if you have more time, you have the means and the desire, and it's not going to detract from the other aspects of your life, to be a more active trader, to be a more active manager of your trades, go for it. I love it when we get people who have all of these different perspectives. Some, even if you're doing similar to what I am doing, you're still going to have some other variation on a theme. And Barry has shared some of the other trades that he's been making with us that have been really, really useful and very productive for him, and that's been awesome to see. Some of you who are more active rollers, I like seeing the different results that you bring in as well, because those have been the kinds of things that allow me to kind of allow me to reevaluate what I'm doing sometimes and refine some of my own methods and my own rules. We're talking about kind of a mind meld of trading ideas, benefiting from each other's perspectives. I may be the one who is facilitating the live stream. I'm conducting it. Therefore, I'm the quote unquote expert. But the truth is, we all have what I appreciate about what we're doing is that this is really an opportunity to benefit from everybody's experience. Barry's been in AUR since August 2024, maybe coming to a nice end. Okay, let's go into that one really quickly. Thank you, and I appreciate the comment. Aurora, okay, wow. I bought it outright for $364. I've had several calls over the time, bringing my cost basis to $209 with a $750 call. This looks like a really, really nice trade. Look at this. This is the stock now at $768, getting called out at $750 when your net cost basis is $209. That's a 3-bagger, almost a 4-bagger, man. That is very nice. So, Barry, here you go. This is going to be a really long. It's kind of crooked, kind of squiggly. I'm sorry, it's ugly, but there you go. You get a big one. Carl, what I enjoy about Rebel Income is that you don't feel like you're stepping up to the craps table. Method here is like building a house from the ground up. Thank you, Carl. I love that. I really appreciate that comment. That's awesome. There you go. You get a heart, because and I totally agree. What we're trying to do is we're trying to build functional. We're trying to be functional investors. I'm not going to try to swing for the fence. Now, Barry, as I just said, he almost hit a 4-bagger here, but he's also had it for August 2024. Here we are in May, so that's about a 9-month trade, right? Still a fantastic result. Do not get me wrong. Barry, because I didn't know much about the stock, I only wagered 100 shares. Had I known, would have mortgaged the house. Well, hindsight's always 20/20. In the meantime, be happy with what you got. So, this was a really nice really nice result. Now, I have to, by way of disclaimer, I have to say here, I'm not familiar with Aurora. I've heard the name. I have not done any analysis on the stock, and the reason is really simple. There's no dividends. This is not the kind of stock you're going to see me include in the Rebel Income system just because dividends are a requirement for me. But that doesn't mean that there aren't some incredible opportunities elsewhere. And to see during a period of quite a lot of volatility in the broad market, right? To see this stock go from a little under, what is this, 350 now to where it is here, 750. That's nice. And Barry, thanks for sharing. In fact, you've done several covered calls on this. You brought your cost basis to 209. He's been using this to generate income, even as he's been watching it increase in value. One time I had a 1250 call on it. So, again, we talk about creating an advantage, right? And this is what's great about the kinds of trades we're talking about with Rebel Income, not just put sales and not just covered calls from stocks that were assigned from a put sell. Maybe you decide to buy a stock outright, and you just decide to apply the method that Barry has done. And he could have just been sitting on the stock from the time he bought it at 364, and he would still have a pretty fantastic result going right now. But by adding covered calls to the mix, he's picked up almost another $1.64 per share, another $164 on 100 shares. That's not nothing, folks. Those are the nickels and dimes Carl was just talking about, and this is a great example of how they add up. So Barry, I really appreciate you sharing this, because you just gave us a really great case study to illustrate exactly the point. So really love it. Made almost $200 in premiums on a $4 stock. That's amazing. It's amazing. Yeah. This will be one for you to brag about. This is your party story stock. That's very cool. Yeah. I agree with you, Carl. That is awesome. We don't always get these, but it sure is nice to celebrate them when you do. Another trader that I know, and if you've been part of the ITG group, you probably heard from him. He talked about luck, and when it happens, you're grateful for it. You don't count on it. So, Barry, not in NVDL at the moment, but it's been fun to play with as well. Yeah, and that's another one. This is an ETF that is tied to NVIDIA. It offers it's basically kind of mini NVIDIA, because it works at a much lower price, about a third of what NVIDIA is running at right now. So it gives you an opportunity to work with the stock on the same kind of basis. The caveat is that doesn't pay dividends. NVIDIA does, really tiny ones. Okay, CSX. This was this week's trade, selling the 2750 strike price. I've been kind of focusing on really boring stocks for the last few weeks, mostly because, not just because of volatility in the market, but because I'm trying to find stocks that really fit into the fundamental requirements of Rebel Income. And the idea of an equity bond has really kind of been on my mind. What is an equity bond? I'm going to just type this up here really quickly. Now, when you hear me say that, I want to get a little bit of discussion going here. What do you think? What do you think of when you hear the term equity bond? can drop your comment in about what you think this is. A couple of characteristics of stocks that generally fit this idea of an equity bond. Equity bond isn't actually a thing. Carl, investment period of time. Okay, good. The idea of an equity bond, like I said, it's not an actual thing. You buy a stock can never be a debt instrument. Solid stocks during a rough market, Barry, that's not too bad either. You're both definitely barking up the right tree. Gib, guaranteed return. Very, very close. I hesitate with the word guaranteed. Just because I don't like the idea of thinking about guarantees when it comes to the stock market. There's too many variances. But the idea of an equity bond, again, a stock can never be a debt instrument. A bond, being a debt instrument, can never be a stock. There are convertible bonds. That's a different kind of beast. That's not what we're talking about. An equity bond is a stock that has some characteristics that make it attractive, Barry said, during a rough market, during uncertain periods. Give it characteristics that are kind of bond-like. So what are some of those characteristics? Income is one. So I'll say a healthy dividend. And it doesn't have to be huge. Very little volatility. I like that. Okay, so it doesn't have to be a huge above average dividend, it just has to be a healthy dividend. Free cash flow, I'm going to say stability, resilience, I'll say stability and resilience. And what I mean by this, Carl said interest rate, not exactly. Again, we're talking about the stock market. Prices vary, so yields on dividends are going to vary as prices vary. So free cash flow, stability, and resilience, meaning that this is a business that continues to generate not just revenue, but they're very disciplined in their financial management. And so what you see is consistent cash flows under any kind of condition, even when economic conditions are less than favorable. They still have shown a historical ability to generate attractive free cash flow. I'll show you a few of the stocks that I've been looking at this week that really kind of qualify and I think fit into this category. Free cash flow stability, cash rich, meaning high liquidity, easy to manage debt. Doesn't mean no debt, although some of the companies that I have been looking at lately, there are some that have very low to zero long-term debt. But debt is not a challenge. Yeah, this is all boiling down to fundamental analysis. You're exactly right. And then what a lot of analysts like to call a wide moat. Now, a moat. Think about this in let's go back to our Robinhood days, right? And I'm not Robinhood, the investing platform, Robinhood, Robinhood and Marion. In medieval period, castles with wide moats were harder to conquer. So the idea here is that if you can identify a company that has some element of their profile that makes them hard to gives them greater stability, makes it harder for people to compete with them. Those are all things that can be considered a moat. So when you see some of these fundamental qualities, cash rich, free cash flow stability, those can be a financial moat. Usually what most people associate with this with is a very strong brand, established position, established leader in their industry. Intel is an example of a company that used to have a wide moat because they kind of dominated the semiconductor space, right? They were kind of unassailable for a very long time. That's not been the case the last few years. A lot of competition has come in and taken market from them. But they used to have a very wide moat because no matter what happened in the market as far as tech goes, everything was going to be going to Intel. Yeah, Barry, now it's full of dragons. Their castle's been assaulted. They're working through that. But that's a good example of something that would have a wide moat. So if you find a stock that has these elements, then you can start talking about how it kind of behaves like an equity bond. In other words, this is a stock that is going to pay you to be patient. When market conditions are unfavorable, it doesn't mean their stock isn't going to go down, but it does mean their business is going to continue to be resilient. Even if, for example, we end up in a recession. Now, I'm not calling for a recession. I'm saying I am looking for stocks that are going to be a little bit more recession proof. And that's where this idea of an equity bond has begun to dominate some of the things that I've been focusing on. So I'm looking for stocks that have some of these kinds of characteristics. They pay me to wait in the form of a healthy dividend. Also, in the fact that because they're continuing to generate this healthy free cash flow and they're cash rich, continuing to service the dividend is not going to be a problem. Their wide moat means that their revenue sources are going to continue to be stable. They're going to continue to be able to lead their industry, and continue to operate fairly normally. Now, these equity bonds, stocks that fit this equity bond description are not high growth stocks. These are not, to borrow from Barry for a second, Aurora Innovation may be a fantastic company, but they're not going to fit the description of an equity bond because that's a growth stock. That's not a criticism. It's just a recognition of the difference. So when you start talking about stocks that fit this equity bond, they're usually boring stocks. Okay, so with that in mind, what are some of the kinds of stocks that fit this description? Carl, is there any particular sector you would look first? I tend to look first for stocks in, for example, food products. Because logically speaking, even if economic conditions are more difficult, then these are companies that should still be able to continue pretty healthy revenues and cash flows, right? Because houses still have to be fed. And that's why you see me focusing on stocks like Conagra. Here's General Mills, right? I'm starting to increase my I've started to increase my exposure to stocks in the food products industry for this reason. Not categorically, though. Barrick Gold is one that I consider to be kind of an equity bond for some of the same reasons. Through several cycles of the economy, they've shown just They're consistent. Their stock is variable, but their operations are consistent. They're very disciplined. And so they have a lot of these same characteristics. Free cash flow is just always generally healthy. They are financially, they're very careful about managing their capital, and they're financially very disciplined. CSX, again, boring. It's a train, but they have all of these same characteristics. And talk about a moat, the barriers to entry in transportation, and specifically in rail, are prohibitive. That's a moat. That's an advantage. Makes them one of only just a few real players in transportation. National grocers are doing well. Kroger's doing too well to jump in right now. Kroger has become a little bit of a growth story, and to be honest, they're not undervalued anymore. Love the company. I enjoy watching the stock, but yes, I agree with that. It's doing too well to jump in. The value proposition is not there. It would need to correct a little bit. And that's fine. All right. I'm going to switch my screen here. I'm going to show you a couple of other stocks that I've discovered this week. None of these are recommendations for a specific trade. These are just examples of stocks that fit this description. Pepsi. PepsiCo is an example of an equity bond. Their dividend is actually pretty attractive at a little over 4% right now. That's really nice. That is above average. But they also have a documented history of generating healthy cash flow in any market condition. They're financially very disciplined. They've been increasing their dividend for the past 52 years. That includes that includes multiple recessionary periods through that time. They've never failed to increase their dividend over 5 decades. They're a dividend king. So that's another characteristic. Here's one that might be a little bit surprising. If you read my post this morning, my report on LRCX LAM. These guys have some of the same equity bond characteristics as well. Again, history of consistent free cash flow, even in uncertain times, even with tariff risks. 2018, 2019, dealing with some of the same fears about tariffs with China. And LRCX, China is one of their biggest customers. They just continue to generate healthy free cash flows. They've got more cash than they've got debt. And as a fabrication company that specializes in fabrication of semiconductors, they are in a very interesting niche. That gives them their own moat, because the guys like NVIDIA, Intel, etc., those are Lam's customers. So these are just a couple of examples. Again, some of these stocks may move more quickly than others. Some of them may not move much at all. But these are the kinds of stocks that I'm really trying to uncover right now, because these have a more conservative profile than some of the other kinds of stocks that we might look at, even for Rebel Income. Equity bond type stocks, Verizon, AT&T are two others that generally fit the description, just because they're really along. You could put T-Mobile in the same category, but they don't pay dividends, which is why I don't. But AT&T and Verizon are also considered to be two companies that are often referred to as equity bonds for the same reasons. They have really attractive dividends and stable free cash flows. Stocks are not immune to price volatility, but even when, if you think about it, even when economic conditions are kind of uncertain, people still need their internet access. They still need to be able to use their phones. So those are stable revenue streams that don't go away. The more I can fill my watch list with these kinds of stocks, the more comfortable I'm going to be that I'm going to be able to keep functional trades going, even if, heaven forbid, we do see another recession. And if we don't, there'll still be good opportunities, because a lot of these have been driven down to extremely cheap valuations. So besides having some of those equity bond characteristics, they also are starting to offer up some opportunities to think about growth, which is kind of fun. Okay, I hope this has been useful. I went on a little bit of a soapbox here at the end, but this is an idea that I wanted to try to explain why you may see some of the things that you do from me in terms of the kinds of stocks that I'm reviewing, the kinds of trades that I'm looking for. Don't look for flashy, because flashy tends to not work quite so well for what we're looking for, especially right now under these conditions. I hope this has been useful as always. I hope you have a great weekend. Enjoy Cinco de Mayo if you enjoy celebrating Latin holidays. If you have any questions between now and next week, don't hesitate to let me know. You can send me an email at rebelincomesystem@gmail.com, or reach out to me on Discord or Substack. Thanks again for your time. Really appreciate it. We'll talk to you next time.